annual year-end giving. And Craig, you touched on that. So you can donate, obviously, cash or securities to a nonprofit of your choice. When you make that donation, it could be deductible on your taxes if you itemize your taxes. Is that correct, Craig?
Well, actually, one of the things that was new to the 2019 tax filing, and then it carried forward to the 2020 tax filing that is going to be carrying forward to the 2021 as well, is that in the past, only if you itemize could you accept or declare charitable contributions. But then beginning with the 2020 tax return, they have allotted a certain dollar amount that you can claim whether or not you itemize. So everyone gets the opportunity to be able to claim this deduction. And so I'm very glad that you brought this up. Share it with us.
My understanding is you can deduct up to $300 if you do a standard deduction, and if you're married, up to $600. Is that correct?
That's correct.
I understand that?
2021, where 2020 you could only do $300 per tax return. So even if you were married filing jointly, it was a maximum of $300. For 2021, that gets doubled if you're married filing jointly. So it's $600.
$600 that can be decreased my total taxable income. Is that correct? So again, decrease your taxes and help the local community. So I love that option. I will say again, as you mentioned, Craig, if in a non-retirement account, if you had significant capital gains, in other words, you've made a significant amount of money in a stock, for example, just like Craig said, a great option is you can donate that stock. You can donate, say, if you own 200 shares, you can donate 100 shares or 50 shares. You can designate how many shares of that stock you want to donate, and so you won't have to pay the capital gains tax because you're donating that stock. The nonprofit receives that stock, they're happy, they can continue their mission, and they can cash it out and not have, most of the time they don't pay taxes on that. And again, it's just a great way to decrease your tax liability and help the community. A couple of things you want to make sure is it has to be a qualifying organization. Not all nonprofits are qualifying organizations, right? So maybe your teen, think about my son asking for all these different things, that's not a nonprofit. Right? So qualifying nonprofits and document your giving, make sure you have records of that. Typically the nonprofit will give you some type of record that you have given to them. Anything to add to that, Craig?
The IRS actually has on their website a guide where you can do a search to make sure that the organization that you're donating to comes up as a 501c3 charity. It's a very helpful tool to be able to go to. That's on irs.gov, and under charities you can do a search for the actual organization because they do document who's been qualified and who hasn't been qualified.
That's very good to know. Yeah, I was not aware of that, so learning every day. Mm-hmm.
Well, on your side too, like if we're wanting to get more, take money and reinvest it, like we're going to receive some money in the next few days, and we need to invest it, we can do that in a Roth or an IRA. Is that correct?
That's right.
With you?
That's right, Debbie. You are getting ahead of it. You're getting ahead of it. Yeah, that's one of my other points, Debbie. That's my next point. So okay. I'm glad you set it up.
Okay.
You want to do the drum roll, and then we'll talk. There you go.
Very good.
So another way to help with your tax liability and prepare is to contribute to your IRA, just like Debbie mentioned. Specifically, a traditional IRA, where it's maybe tax deductible, depending on some circumstances, but most of the time it's tax deductible. You can contribute up to $6,000 into a traditional IRA. If you're over the age of 50, Debbie, I'm not saying you are, but if you are, you can contribute up to $7,000 if you're over the age of 50. And that's you and your spouse, so you can do $6,000, your spouse can do $6,000, right? So total as a married couple, 12,000, right? So you get that. It may be deductible, but there's also this other cool feature. Depending on your income, there's a tax credit available. Is that correct, Greg? Have you seen that?
Which tax credit are you referring to?
When you contribute to an IRA, a traditional IRA, part of it you may get a direct tax credit for contributing to an IRA depending on your income. It's something new that I saw.
That's correct. There is an additional bonus that's going into that. And so we're still working through the particulars of it. The amazing thing about tax law is it changes constantly and consistently. This week we're finishing up all of our continuing education. It's a great opportunity to get into all that wonderful tax law.
There you go. Exciting tax law. You do need earned income, though. You need earned income to contribute, Debbie. That's a big one. So earned income is wages, salary, commission, self-employment. There are a couple others there. But things that don't qualify are your Social Security income or your disability income. Those don't qualify. So you do need some type of earned income to contribute to your IRA. It used to be that if you were 70 and a half or older, you cannot contribute to your IRA. The Secure Act, again, in 2019, changed that. And so if you are over the age of 70 and a half and you have earned income, you are able to contribute to your IRA. If you already have an open and existing IRA, you can contribute to it. So that's pretty exciting for those of you who are still working over the age of 70 and a half. So one last thing.
Okay.
Spousal IRAs. So if you have a non-working spouse in your home, so if one spouse is working and one is not, that working spouse is able to contribute for that non-working spouse. Again, you have to be married, you have to be filing jointly, and one of the spouses needs earned income. So you are able to contribute for your spouse. That's another option. Should we move on to the next point? Or what would you like to do?
Have you got another point?
I do.
Okay, we'll let you, and then we'll get Greg.
Okay.
And then we'll talk about all this.
Last one I have, again, Debbie, I'll let you do the drum roll. Tax loss harvesting. It's where you offset a capital gain with a capital loss. In other words, if you've made money in an investment, you can offset it by an investment that has lost money. And so the two can offset each other. So for example, if you've owned, and this is again non-retirement, and this is something you do have to do before the end of the year, December 31st. I'll backtrack. For your IRA contributions, you have until April 15 of next year to contribute for this 2021 tax year. So you do have some time there. But tax law harvesting, for example, if you own Costco stock and you made money, you sold it, you made $1,000, and say you owned GameStop stock that has lost money, and you can sell that lost stock, and now the two can offset each other and thereby decreasing your tax liability. If you've had a stock that's only lost and you decide to sell it, you can deduct up to $3,000 of the loss on your tax filings. So that's another option as well. One thing is you cannot buy the same or similar security 30 days before or 30 days after, so you can't trick the IRS. You actually have to sell the loss and not buy the same thing for at least 30 days. Anything to add there, Greg?
You're doing a fantastic job. And that is the key. It's that 30 days. You want to make sure when you start doing these transactions that you understand the parameters that go along with it. Mm-hmm. So it's more than just, I want to declare this loss and I'm going to throw that on my tax return, but it really is a good investment, so I'm going to pick it up the next day or the day after. You have to make sure you follow those parameters as you go through. So thank you for mentioning that.
Yes, sir.
Because a lot of times people gloss over that. They hear the good and don't understand what goes along with those terms.
That's right. You cannot trick the IRS, folks. You can try, but may not end well for you.
Yeah. Are you ready for us to
I'm
move
ready.
to Craig?
Yes, Craig.
Yeah, so he's going to talk to us about the accounting end and the bookkeeping, and if if you have a business, and he is located in Fort Oglethorpe on Lafayette Road, so I'm going to turn it over to him.
Well, thank you very much. I appreciate that. Like Gio mentioned, I first want to mention thank you so much to the Chamber for all that they do for us as an organization that literally advocates for businesses, not just so much as letting you know, probably the most important thing is letting you know what's going on in the community, letting you know what businesses are here, and promoting them, because the more businesses we have in the community, the greater our tax base is going to be, the greater services that can be provided to the community, and also the greater the employment opportunities that are going to be here as well. So it's win-win-win for everybody, and I thank you so much for our very active chamber that's going on. She said a mouthful in all of her announcements that were here this morning. I'm trying to remember all those dates, and certainly they're posted on the website, I'm sure, so if you go back to that. But make sure you tune into those. Some of the individuals that she mentioned are great, hardworking people. I can't tell you how many times I've gotten an oil change up there at Greased Lightning. Thank you, Mike. Thank you, Tom, and everybody up there at Greased Lightning, or Pam's place. We just have a great community of businesses, so thank you very much for having us in here and having us on today. Going beyond that, now into the great discussion of tax law. I'm too going to try not to put you to sleep. As I mentioned, we have 18 to 25 hours of continuing education that we do every year to make sure that we're on top of things, bring in new tax law, make sure we've got everything secure for the tax returns going forward. And there's so many sides and facets to it. Obviously, I'm not going to be able to cover it here in this entire program, but I'm going to kind of boil it down to, in essence, two sides of the equation: individuals and businesses. Because they're two very different treatments that you apply to them. And sometimes you'll get an individual who owns a business, and that takes even more special treatment that goes into it. And so I'm going to start with the business side of the equation. For your businesses, we work on a lot of companies that are around, and you just want to make sure that you're working with, there's a lot of great tax softwares that are out there. A lot of people go to them and they prepare their tax returns. But when it comes to certain questions, like say, depreciation, how should I calculate my depreciation? Do I want to use the straight line method, the maker's method, the 200% method, the 100% method? Do I want to claim Section 179 deductions? All of these great things that I'm sure each and every one of you know about, ins and outs. Those are the types of questions that comes up through these tax software that you really need to know and understand when you're hitting the button. This is the one I want to use, how it's going to affect you overall. And so I want you to know that we as a business, Providence Associates, we consider ourselves to be here for the entire community. So whether or not we're preparing your tax return, if you've got a tax question like that, feel free to give me a call. That's what I'm there for. 706-841-0600. If you're working through a tax software and you've got a complicated question, I'd rather you get to the right answer than mess up your taxes, because we care about our community. So I wanted to bring that to your attention. So as long as you're a business, the important thing to remember is to take a look at, today's December 27th, December 31st is just around the corner. It's your last opportunity to take a look at how you're faring overall and what those tax implications are going to be. And whether you're set up as a self-employed sole proprietor, whether you're set up as a partnership, an S corporation, or a C corporation, each one of those has different tax implications to it. And so you want to make sure when you're looking at your profit and loss, and you know the bottom line taxes, how you're going to get hit. Are you going to get hit with the self-employment tax that's there? Are you going to just have a flow-through that's going to go to your personal income tax return? Is the company itself going to get hit? And what's its tax bracket going to be? So just start getting these questions answered, because you've only got so many days to make the determination. Do you want to give year-end bonuses to the owners? Do you want to do a profit sharing to all the employees? Do you want to take the opportunity to, give hams to everyone for a great new year that you've done? Whatever the case may be, now is your opportunity. Or is it something where you're going into the next year, there's a piece of equipment that you really could use that would just explode explode your business. And by buying that piece of equipment before December 31st, it's going to allow you to take that deduction and not have to pay income tax on it. So if you're buying it anyways, it may make sense to do that before December 31st. So please, in the next few days, lay out your tax planning and make sure that you know what you're getting into, so that you don't get the big surprise, you've got a tax bill. I'll never forget, how many clients we've had like walking through our door. I had one just come to us last year, and he said that the reason he came to us was his tax preparer got his taxes done and just kind of laughed and said, "You made a lot of money last year, didn't you?" And that was his only response, and presented him with a $160,000 tax bill. That is a shock, a surprise. While we believe the government needs their resources to be able to do what they do, we don't believe it needs to be the pounds and pounds of flesh that you as a taxpayer are earning through your hard-earned income. So make sure your tax planning gets done appropriately. See what you can do to cut those back, whether you're a business, or let's move on to an individual side of the equation as well. Are you a sole proprietor where you have a home-based business? Are you going to have possible deductions that you can take there? I've got a lot of contractors that we work with, and you'd be surprised how many contractors. We had one walk through our door that every time he went out and he did a job and he got paid on that job, that's exactly the income that he paid income tax on. He didn't realize just by driving to the location that that was deductible mileage that he could use. He didn't realize that the supplies that he used on the job site could be deducted for his business purposes. So he was paying a huge amount of taxes that was there. So these are the things that you want to ask as an individual if you own a self-employed business. If you're an employee and you've got a W-2, the thing that we notice and the pitfall that we keep running into is if you're a dual income household. So you've got a husband that works, you've got a wife that works, and each company, the husband works, here's his income. They withhold based off of just what they see, which is his income. The wife, they withhold the same thing, only what they see. But then all of a sudden you add the two incomes together and they end up in a higher tax bracket. So those types of things require planning, and you want to make sure that when you add the two W-2s together, what's going to be their tax bracket? Have you done the appropriate tax planning for that? Are there further deductions that you can take a look into and take advantage of? Do you want to make that call to GEO and say, hey, I need to make those IRA contributions because I'm going to get killed if I report this on my personal income tax return? So make sure you take the opportunity to look at those things as you're going through and doing your tax planning. And then, of course, we have some new things that are coming up this year. As we mentioned, there of course, was the carryover related to the charitable contributions. But then how about that advanced child tax credit that came out? Not only did they increase the child tax credit to $3,000 per child, but then all of a sudden they said, well, hey, we're going to start paying it to you in advance. We're just going to send you a check. And unless you tell us not to, you're going to get payment on it. So if you filed your income taxes and you opted for direct deposit, it just showed up in your bank account. If you didn't, if you filed on paper, or you said, mail me a check, then at that point in time, they would go ahead and mail you a check on your advanced income or advanced child tax credit. And so unless you opted out, then of course they sent you the check. Now all of a sudden you can't claim that, or you have to let them know that you've already been paid on that up front. And again, that's part of your proper tax planning that needs to get done. So I've got down here written or pulled up a communication from the Internal Revenue Service. I want you to be on the lookout for. If you receive the child tax credit this year, please look out for, in the mail, the IRS is going to send you a letter. It's called letter 6419. That's the number that they gave it. And this is going to report the amount that was paid to you in advance on your child tax payment. That is a very critical document that you'll need to take down to your tax preparer when you get your taxes done. Because it'll say, okay, not only were you eligible, but you got paid this amount of monies. It's reported right there of what they're reflecting on their records. And then your tax preparer, or if you're using a software, you enter this on your own, then that will have to be entered as you've received the monies already, and you won't be able to claim it as a credit on your income tax return. So please keep that in mind. That's letter 6419.
It's new.
It'll come in one of those letters that says important tax document. That's a flag right there, important tax document. Don't throw it away, okay? Make sure you hang on to that letter. As well as, for years now, many of you have been able to enjoy the advantage of healthcare.gov and signed up through insurance from the healthcare platform. And so if you're doing that, of course, they send something out in addition. That's that 1095-A form. Make sure you hang on to that as well and either report that on your income tax return on your software or paper, however you're filing it, or provide it to your tax preparer so that they have the appropriate information, because that lets them know how much got paid out on your behalf as well as how much you're eligible for, so that they can appropriately reconcile your tax return. So a lot of documents are going to be coming out. Last year we had 1099s that got split up. So it wasn't just the 1099 miscellaneous that everybody got. Now all of a sudden there was a 1099 non-employee compensation, or NEC as they call it. Be on the lookout for that. That hits a lot of our contractors and self-employed individuals, or if you've got a side hobby or something that you're collecting income from, make sure you've got that. Because if you don't report that on your tax return, I assure you the IRS has a copy of it, and they will amend your tax return for you, and you won't be able to plan for it. You won't be able to take deductions against it. They just say, okay, here's the additional income. So make sure you get that reported on your income tax return. So there's a lot that's going on. And then, of course, this year, you recall last year with the COVID situation, there were a couple of payments that went out, and there was the initial $1,200 per adult and $500 per child. That was the one that went out in like April or May of 2020. And then, of course, it got followed up with an additional $600 that went out towards December of 2020 / beginning of January 2021. Well, those two actually got reconciled on the tax returns. And so if you didn't get the monies, if you didn't get them in your inbox, or you didn't get paid from them, your last opportunity was to be able to report that on your income tax return for 2021. Well, the same applies to this year. And this year they're actually sending out a letter. It's called letter 6475. Again, you'll want to keep that in mind, letter 6475. And that has to do with the stimulus payment that we were paid. You remember they did the makeup one to get a total of $2,000. There was $1,400 that went out to all the taxpayers back in March of this year. And so the IRS is going to be sending out that letter. That's going to need to be reported on your income tax return as well. Whew, a lot going on where income taxes are concerned.
Right.
Both individual, business, it's a mouthful, I know, but these are things that you need to keep in mind when you're doing your tax planning, your tax preparation. And so whether you're using a software or a tax preparer, beware, it's coming up. We're right around the corner.
Do you think they will extend the deadline this year like they did last year, or not?
I don't think they will this year, actually.
Okay.
There hasn't been enough probable cause for it. They haven't done it officially. It would take a special act to go through and do it. So as of right now, we're having to proceed as though it hasn't been extended. So keep in mind those dates. For businesses, whether you're a partnership, a Schedule C, not a Schedule C, a C corporation, an S corporation, all of those have March 15th deadlines. You'll need to keep that in mind. And then, of course, for individuals, everyone remembers the date of?
April 15th.
April 15th.
That's the day.
The glorious day to remember every year.
Stand in the postal line and get it marked so it'll
That's right.
before midnight.
That's right.
My pastor has 7 kids, so I think he should probably give you a call and get all that figured out, Greg.
Yeah, I was wondering if you didn't mention anything about a Roth.
Mm-hmm.
Is that still a good plan for people to pay the taxes if?
Mm-hmm. So before I answer that question, I just want to hit the drums again. So let me go ahead and do that, Debbie. So a Roth IRA, it is a great option. I love Roths, but it does depend on your income. It is limited. So if you have a very high income, then a Roth IRA is not available for you. But a Roth IRA, you're taking your tax benefit in the future. So you get no deduction today. So you can contribute to a Roth IRA, but you will get no tax benefit today. It's what we call after money that has already been taxed, so after tax money that you put into that account. And in the future, when you do retire, then you can withdraw that money tax-free, which is, sounds fantastic, right? Tax-free. I just love saying those words.
It sounds good to me.
And so if you can definitely contribute to a Roth IRA, but you don't get any tax benefit today for the 2021 tax year, but you will get your tax benefit in the future. So that's a great option as well. It maybe your tax burden is not significant, or maybe you just prefer that benefit in the future, then that's an option for you. Thank you, Debbie. Yes.
And the beauty of tax planning and working with, like Gio and I have shared clients, and so what we do is we take a look as we're preparing their income tax returns, and we say, okay, here's how much money we're reflecting as your income. Based off of that, your tax amount is X number of thousands of dollars. So then we start breaking it down to, if you take $1,000 and contribute it to an IRA, a traditional IRA, here's what your tax is going to look like, and so on. And so that's when we engage Gio and start talking about, do you have a platform? Can you invest them? How can they best invest? Where are they? At what stage of life? All of these questions he starts going into, because it's not just a simple, well, we're going to open up a retirement account.
Right.
The professional like Gio is extremely helpful to have, because he's going to take not only those tax-saved earnings that are there, but then he's going to multiply it exponentially. So that's why you want to ask yourself. Or you may come out where you don't owe much in the way of taxes, and so at that point in time, we have the opportunity to say, well, you don't really owe money in taxes. It wouldn't really benefit you to have a traditional IRA, but if you take the money that you would have invested and put it into a Roth IRA, just like you mentioned, Debbie, then at that point in time, that's tax savings in the future. You're banking that opportunity for years down the road to where you can pull that out tax-free. We love those words,
yes.
Tax-free.
And I had a great example as well. I love having Craig next to me because I can run over anytime and bother him and his wife, and they're always so gracious to have me over. But I had a client who, was retiring, and she had some goals of paying off the house and paying off some other things, and so we had to look at how would those distributions from her IRA impact her, and whether we should take those distributions this year, for this tax year, or for next tax year. And so I said, I don't know, let me go talk to Craig. So I ran over there, we ran all the numbers, and he broke it down, and we came up with a solution together, and we were able to help that client make the best decision for her to meet her goals in a tax-efficient way. So that's just love, partnering with you. Appreciate that. Thank you, Craig.
That's why I put y'all two together. I knew y'all would work great. No. Another thing is, if you're going to take money out of an IRA, because you have to, and I'm not at that age yet, but I'm getting close. So if we have to take it out, and you have money in two different investment companies, your old company and you've taken money and invested it yourself, does the IRA make you take it from both places or just one place?
So that's a great question, Debbie. Most of the time, this is, I'll tell you what folks do. And what seems to be a little bit simpler is, for example, if you have an IRA, say with me, and then you have another IRA with the bank down the street, and maybe even a third IRA at the credit union. Okay. Each bank, each financial institution is responsible to give you those numbers. We tell you what the IRS says you should take out, and you can, you take out from each bank or each financial institution. You could add all three and just take it out from one, and that would satisfy it as well.
Okay.
But typically folks just go to that institution and say, what do I need to take out? And whatever that amount is, they'll take out. So,
Okay. I didn't know, because I was thinking, if you got it different places, there are communications, or are they looking at saying, okay, within, you need to take this money now?
Right. And you do have to make sure you go to all the different financial institutions that you do have an IRA at, right? So if you have one with me and you take care of ours, that doesn't necessarily take care of the other two that you may have out there. So it is important that you do look at all your retirement accounts. Great point, Debbie.
Yeah, because a lot of companies, used to, you got retirement benefits, but now they invest the money in IRAs and things for you.
Right.
And then you have other investments, so what about if you sell something toward the end of the year, very close to the end of the year? What if it happens on the very last day? Do you still have to count that as capital gains?
Are you referring to real property, or are you referring to stock? Property? It becomes capital gains, and capital gains eligible from the date of the sale.
Okay. Different people have different deadlines for paying their sales tax, or different, and you do all of that too with companies.
We do, and that's one thing. I love some of our clients that'll call me, and it'll be like, I don't know, April 17th, or it'll be June 23rd, and they'll be like, well, you have nothing to do the rest of the year. Can't you just take care of this real quick? But what they don't realize is that we have clients that are year-round. And so whether it's we're processing payroll tax returns, and we have to do the quarterly tax filings for them, the 941s of every quarter, the unemployment filings that get done with the state, the withholding if they're in Georgia or Alabama, not Tennessee because they don't have income taxes, but of course we process those as well. Plus sales taxes you alluded to. I mean, those are due by the 20th of every single month. So 12 out of 12 months we're filing sales tax returns that have to be done for those as well. On top of the annual filings that get done, whether it's the business tax returns, the individual tax returns. And we have, our firm actually started with a lot of churches and ministries and pastors involved. And when it comes to ministries and nonprofit organizations, they have their own special deadline that you don't hear about very much. It's not publicized. That date is May 15th. So we're a firm that goes all the way, our 10th date is all the way through May 15th. So we love May 16th instead of April 16th. We get that extra month to share with our nonprofit clients that are there. And we really do enjoy serving that community, that faith-based. I've always told our clients I'm not one that necessarily was engaged to preach in front of hundreds or thousands of people, but I am a great support person to those that do. That's why I love serving pastors and ministers and lay people. I understand what they're doing, and they have their own special tax obligations and tax opportunities as well. You take, for example, a pastor and their housing allowance, like the military gets a housing allowance because they're serving the military. Well, pastors go way back on being able to utilize a housing allowance and a parsonage allowance, whether they're renting or whether they're buying. And that's a whole different animal. It gets played out differently on their income tax return. And then, of course, it also ties into the actual church and how that gets reported too. And then, of course, a big deadline everybody thinks of is, I want my W-2, I want my 1099. Well, that's another one that's coming up right around the corner. January 31st. We've got to have those in the mail and postmarked by January 31st for W-2s and 1099s, on top of all the quarterly filings that get done for the fourth quarter.
And you have a staff that helps you, but you're always probably looking for a new accounting person to help out, or have you hired a full staff now?
I'm glad you mentioned that. Yes, we are hiring. I appreciate the setup on that. We are hiring, and so you'll find we are a great, warm, friendly family firm, and so we're open to welcoming another associate or two, maybe even three. We don't know. It's going to be a busy season this year. We already see it on the horizon. We recently lost an individual that moved on, and so we consequently we're going to be hiring through changes. And so if you're out there, you're eligible and available, we are an opportunity. Maybe you're dissatisfied where you're at currently, they don't appreciate you like we would, then certainly give us a call.
And it's convenient and easy parking, and you don't have to go downtown and worry about the traffic.
That's right, yep. And
There's some
located-
great accounting firms downtown. We have some great members too, but you'd be in historic Fort Overthorpe next to the park and just take your lunch break and take a break.
Take the scenic route.
Right.
See some deer. It is beautiful. It's a beautiful drive to the
And,
office.
and Gio's right next door and you can visit with him, so.
That's right. Never any cost, just to talk. Like Craig said, just enjoy helping people and answering questions. And if there's something we can do, a way we can serve or help you, we'll be glad to do it. And I'm glad you mentioned businesses. I do help the personal side and also on the business sides. And businesses do have many opportunities for different types of retirement accounts for them and for their employees. It's a lot more affordable than many people think. So